What is capital? Capital is defined as the financial assets held by a firm or funds obtained through various forms of financing. While it can have multiple meanings, in finance, it primarily refers to equity, debt, investments, and working capital. In economics, capital encompasses human capital, representing individuals' capacity to contribute to economic production. Although natural resources are generally excluded from financial and economic definitions, money itself is not strictly classified as capital, rather, it serves as a means to purchase goods and services that ultimately become capital. For instance, investments in financial instruments represent financial capital. Thus, while cash held by a firm may not qualify as capital, it transforms into capital once invested in business activities. Financial capital comprises several components. 1. Debt. This is a common form of financing for businesses, allowing them to borrow from banks or family members to fund operations. While debt can be a straightforward financing method, the interest incurred can make it expensive. In the event of a business failure, the borrower must still repay the debt, but profits do not need to be shared with lenders. 2. Equity capital. This capital comes from investors who contribute funds during a company's initial stages in exchange for a share of future profits. Businesses that self-fund retain full ownership and profits. However, attracting angel investors or venture capitalists can dilute ownership and future earnings. 3. Working capital. This consists of a company's most liquid assets, readily convertible to cash for daily operations. Working capital is calculated by subtracting current liabilities from current assets or adding accounts receivable and inventory and then deducting accounts payable. Financial capital is distinct from economic capital, which refers to the funds needed to recover from losses and manage risk. While financial capital is commonly used across businesses, economic capital includes human capital and production tools. The cost of capital involves expenses related to acquiring financing. It varies based on interest rates, coupon rates, and yield to maturity for debt, while the capital asset pricing model, CAPM, calculates the cost of equity. Generally, the cost of equity is higher than that of debt due to greater associated risks. Capital is crucial for business growth and expansion, enhancing productivity and enabling the delivery of essential goods and services. Businesses recognize the importance of maintaining capital and employ various methods to ensure its effective management.